Did you know the murder rate after you win the lotto skyrockets, and it's almost always a family member that kills you? Yeah, look into the percentage. It is insane. Your second cousin, like 3 times removed, will all of a sudden come out of the woodworks and kill you. Look at the numbers. It's insane. Seriously, it's the weirdest statistic ever.
Well, let's not go down that route.
Okay.
Welcome back to the Ask Avidian podcast. I'm Jake Borbidge, Chief Investment Officer with Avidian Wealth Solutions, and joining me again today, Robert Palmer, our Head of Financial Planning. Robert, are you really going to play the Powerball this week?
Absolutely.
So $1.7 billion, that's a pretty big number. It makes
a huge
difference,
number,
right?
and I have a deep-seated aspiration to be the most successful lotto winner of all time.
Okay, so what does that mean?
What does that mean? It means I somehow managed to keep all my money and not get murdered.
Okay. Tell me, why are you going to get murdered?
Well, it's actually a really funny...
Well, hold on, first of all.
Yeah,
you're going to keep all the money? $1.7 billion.
Well, not all the money. There's some taxes I got to take out at the front end. And you have a choice, right? You can annuitize it, get payments over time, or take a lump sum. I personally would take the lump sum.
Okay. And once you take the lump sum, most, I guess, tax-efficient way to do that, is that what you're thinking?
Well, you're going to get dinged with federal and state income tax, or if you're lucky and you live in Texas, no state income tax, and then you keep
to Texas just to play the Powerball. That's what you did, right?
That's what I did.
So once you get past the tax situation side of things, how do you avoid getting killed?
Yeah, great question. That's where creditors start coming into play. And I'm not just talking about banks and debtors. I'm talking about spouses. I'm talking about family members.
Your spouse is a creditor.
Absolutely.
Never thought of it that way.
Absolutely, because spouses become ex-spouses at a rate higher than 50% here in America.
Okay, good point. Good point. So, so again, how do you avoid getting killed? Is it an estate plan that you put in place that protects you and the assets?
Yeah.
Is it a bulletproof vest? Judo?
Little column A, little column B. You could have a good friend named Jake Borbidge who's over 6 feet tall that can protect you too. And you
I
can
ain't
pay
taking no bullets, man.
I would say
I will be behind you in that confrontation.
I would say business interests, trusts, and working in the family members that you trust into the plan would be the best way to go about protecting the asset. So I'll expand a little bit on that. So the first thing that you could do is actually if you're married, for example, and you got a good relationship with your wife, you're going to have those assets come into your marital estate, right? That's going to be part of your marital picture. The first thing you'd want to do is set up what's called a SLAT, so a spousal lifetime access trust. You fully maximize your lifetime exemption, which is $13.99 million this year, $15 million next year. So pretend it's 2026. Or actually, let's just use this year. You got $13.99 million. You stick that in a SLAT. You make yourself the beneficiary. Your wife is partitioning the assets, and now you got something that's creditor protected. You have unfettered access, but you could also just let it sit and ride and be completely estate tax exempt. So you're saving 40% of that on the back end, because God knows the government would take 40% right when you die.
God knows.
God knows. So it's the only certain thing you can rely on, death and taxes, right? So that's the first thing I would do. And that protects $13.99 million and all the future appreciation. That gives you a cushion. Everything else is gravy. Now you can literally do whatever you want. But the important thing is to figure out what you can buy to give yourself some protection. And if you leave it sitting in a bank account, you're missing out on an opportunity. So what I would do is start looking at businesses and real estate that I want to own and create entities that would then house those interests, that would provide creditor protections and some tax deductions over time, and also start producing income streams. And that would create a base. And the reason why that's important is because if you just leave behind cash, it's going to get burned. You need to create a foundation that has cash flow, and that's what gives you protection.
You know what I'm hearing? More money, more problems.
That's right.
I also heard that if you win $1.7 billion, you're going to give your wife 13 to 15 million. Less than 1% of your winnings is going to your spouse.
It's the only thing you can protect.
If you are listening, one way to look at it is you're going to get $15 million because Robert's really good at the lotto, but the other way is this is how much he loves you.
Actually, technically, I said something even worse than that. I said it would come into the marital estate, and then she would fund a SLAT for me. So it's even worse than you think. I would just be my own separate property carved out from the marital property. The SLAT I would create would actually be for the kids.
Okay. And so if you had to rethink this, right? Maybe it's not a business. What's like you get this huge helicopter drop of money on top of you. What's the first thing you buy? Is it a business or is it a toy?
Oh man, I got to tell you, the first week you win, you kind of deserve to give yourself a little bit of a break because you just got a huge
little cheat day on your budget.
Little cheat day on the budget. I would go out and treat myself to the most expensive vacation with all the people I love most in the world and just create a moment that I would never forget.
Okay,
that's
so
what I would do.
That's awesome. That sounds like a great plan. So if you are hearing this and we're still playing this message, Robert probably did not win the lottery.
Oh, man.
I'm giving it 50-50 odds, though. I have a lot of faith in you. I think you're going to be awesome.
Those are high odds for the lotto.
Yeah, I think you're going to do great. Okay, any other last little tidbits? Because I think there's some parallels here, right? I mean, obviously, not a lot of people win Powerball, and it only gets to this size, every couple years probably. But receiving a large liquidity event, that does happen fairly frequently, especially with some of the clients that we work with through selling a business or having a large, appreciated gain that needs to be liquidated. So I think some of those parallels probably make sense just in kind of the more run-of-the-mill liquidity events. Is that right?
Yeah, that's exactly right. Figuring out where those proceeds are coming into or where those proceeds are coming from, how they're going to be taxed, and how that fits within the larger financial picture, absolutely critical. And you can actually plan that whole thing in advance so nothing catches you off guard.
Yeah. Awesome. So let's pivot to a couple news items for today. Some things that I thought were kind of interesting. First off, I read this morning, or I should say I listened to it. I wasn't texting and driving. On my way into work, I observed through my ears that Goldman Sachs is now, they've got some kind of partnership or relationship with Rowe Price regarding private investments. And I know T. Rowe, as a public company, has struggled a little bit. They've got a really strong reputation as an active manager, but some of the active performance has been a little soft over the last couple of years. So their stock price has just been kind of challenged. Also, just generally the active management industry has been in a little bit of a decline, kind of secular decline for the last couple of decades. And I know T. Rowe has tried to get into the private markets business among, probably all the other large players in the active management kind of public market space, but they haven't been super successful. So the article today kind of, nodded to the fact that they were going to start, I'll call it co-distributing or co-developing products that are going to allow them to, have some aspect of Goldman's private market lineup in their ability to distribute products, maybe even some products that house both public and private equities. Kind of interesting. We're seeing that start to develop, and 401k plans are starting to do something like that as well. So I see this kind of article and my mind goes in a couple different directions. One of the things that I think about is, if I'm a distributor at T. Rowe, and now, maybe I'm happy that I have new products to sell, right? As a salesperson, you always want the best product behind you because it makes your job a lot easier. But public and private markets are vastly different from a number of different angles. The vernacular, the vocabulary that kind of explains how private markets work is very different from public markets. The thought process in terms of how they fit into portfolios also very different. You go from a relative, I'm going to beat a benchmark mindset on the public side to a more absolute return. I've set a return target. I'm going to try to beat an absolute return. So relative risk versus absolute risk is kind of more the mindset on the private side. So there's a lot of differences. If I'm a wholesaler, I've just got kind of thrown into the deep end. And I think you see that especially with regards to wealthy families. A lot of them, I think right now, are being kind of thrown into the deep end because, 10 years ago, there were no real private market investment opportunities for these families. Now they're becoming more and more, frequently offered to them. So, I mean, Robert, if you look at it from your perspective, I mean, what would your advice be to that distributor? Like, how do you get up to speed on the private market side of the world? You gotta do it fast. Right?
You can't do it fast. And actually, I was going to throw that question right at you.
Okay.
But here's what I'd say. This has been an ongoing trend for several years now, where different providers have provided people with access to private markets, even in the self-directed accounts. Like SoFi, for example, will offer private market access sometimes to pre-IPO companies and things like that. And the issue that I always see with these is the risk profile. And to your point, the vernacular is completely different. The math is different. How you gauge the risk, the timeline, how liquid the alternative is, whether it's satisfying an income need or you're looking for rapid appreciation or you're just looking to diversify away from those public roller coaster moments, where the market's going all up and down.
Yep.
My question to you is, with all these providers coming in, do you feel like these private market offerings are sort of like a fad, almost like meme stocks were, or do you feel like this is really serving a need that's going to help investors outperform?
So I would be on the latter side of things. I think that if done well, I think it is meeting a need. As an investor, I'm a big believer in diversification. There are large pockets of the market that can't be accessed with traditional investment vehicles like ETFs or mutual funds or just buying things on an exchange. It used to be the case that the publicly traded world was the whole world when it came to investing, and now the privately traded world has grown considerably. And so I think if you want a diversified portfolio and you ignore the privately traded or the private businesses and private credit, you are kind of selling yourself short because you're eschewing a large opportunity set without really kind of looking into how it might benefit a portfolio. However, I would say that there are definitely private investments out there that investors should probably avoid, right? And so part of our job is to spend a lot of time looking at this stuff, doing our research, not just understanding the asset classes. Do we want to own private equity or credit or venture or any subset of those asset classes? But then looking at the manager, does the manager or the sponsor, we call them sponsors in the private side, managers on the public side, but does the sponsor have, skill in that particular asset class? Or were they really good at another asset class and they're kind of just, spilling over into a new asset class where they think they can, earn a reasonable return, but really kind of it's more of a business decision. And then we also want to understand the vehicle and the structuring, right? And so with rapid product development, you're going to get some products and structures out there that are really good and very, I'll call them investor friendly. And you're going to get some structures out there that are maybe more kind of business and sponsor friendly, or really just kind of structurally inefficient. And we've seen a couple of those. So, early days, the interval fund structure was pretty commonly used. I think the BDC structure has been a little bit more frequently used over the past couple of years, and there's some benefits to that.
BDC,
business development company. Sorry, yeah. Appreciate
lots
the
of acronyms
there.
in this world.
Yeah. Try not to use acronyms. One of the acronyms that I always get tripped up on is AI. Right? AI used to just mean accredited investors, and now it means something completely different, but still also means accredited investors. But yeah, going back to the structures, right? So interval fund structure is one that, as a firm, we've tended to, shy away from. There are some asset classes where it can make sense, but we tend to view the required liquidity in an interval fund as something that's a little bit of a hindrance for most private investments.
What is an interval fund, just to back that up?
Sorry, so an interval fund is a fund that can buy private investments and that you can usually transact on a monthly basis. But the minimum investment requirements are lower. The investment or investor qualifications are lower, so you may not necessarily need to be an accredited investor. Definitely don't need to be a qualified purchaser. Your minimum net worth level requirement is lower. But then the vehicle, the structure has different requirements inherent in it because it needs to be able to ensure a level of liquidity. It typically has to own a meaningful percentage of liquid assets, right? Publicly traded stuff that you can get through other vehicles like mutual funds and ETFs.
Yeah, you said you could transact monthly. So does that mean that you have monthly liquidation periods where if you wanted to pull out, you could?
Yeah, so typically you'll have some monthly liquidity provision. It's not full liquidity, but it is a portion of the fund, and that can put you into some tricky situations if you get a large liquidity demand on the fund, and then you don't. The fund may not have enough liquidity to support it. That kind of puts the fund in a difficult spot. And so we haven't used a lot of those structures for our clients. We've tended to want to gravitate more towards things that have, occasional liquidity. Could still be monthly, could still be quarterly, but it's more of on an as needed basis, which means the fund doesn't have to provide the liquidity. Now, that doesn't sound great on the surface because it means, well, you may not be able to get your money back out. But what we're trying to do is we're trying to protect or select vehicles that do not put themselves in a forced seller position. So one of the things that we think is really important to avoid in the private market space is that you always have liquidity working for you, meaning that you're providing liquidity to where it's scarce. and you're never on the other side where you're demanding liquidity in an area where it's scarce, right? That's the opposite side of the equation. You don't want to be there. And so we want to make sure that the vehicle structures we pick also don't put us in that position.
So it's deploying the capital rather than just keeping it available for like redemptions, for example.
Yeah. Another thing that, I kind of noticed, like going back to the article and looking at, okay, Goldman, private markets, they have a really strong private markets capability, nothing against them. It's more kind of the math of mixing privates and publics together, whether it's in the same vehicle or in the same portfolio. It does create challenges, and it requires you to have a really clear view of your liquidity needs and your portfolio construction plans, both over the short term and over the long term. And the reason we know this is because we have seen large, highly sophisticated institutions get into some, predicaments with their own liquidity profiles. These are institutions that have investment teams working, full time for them, just looking at these types of investments and understanding the liquidity of those institutions. There's some college foundations that are pretty sizable. I won't name any names, but they had an initiative. Hey, we want to get the best risk-adjusted return for our money that we can get. That led them to use a decent degree of private markets, and that was by and large a fairly successful decision. However, the math behind that, let's just say your target for private markets is 50% of your portfolio. So you get to that allocation and you have 50% public, 50% private. Well, if it was a good decision, those private markets are going to outperform the public market. So 50 becomes 60, becomes 70, right? That's, what a correct decision would do in that situation. And that's just if things are going well. If public markets then sell off, maybe your 70 becomes 80 and 90, right? So you start to see how the math, and this is more of an extreme example, but the math of public versus private can really kind of get you on the wrong side of your liquidity picture pretty quickly. So you just want to make sure that you really understand, number one, what your liquidity needs are, what your spending needs are. Probably best if you consult a financial professional to help you kind of work through some of those considerations. And then the other thing that really comes into play with regards to mixing public and privates is the language that you describe what you think good looks like in a portfolio. And the way I would describe that is, if you look at private investments, one of the things that we like about private investments is they diversify. You need to say something.
Well, I was going to back up. You were on a roll. I didn't want to interrupt it. But if we're backing up, there are a couple questions that I wanted to ask.
Okay.
So earlier when you were talking about the appreciation of the alternatives, one of the things that kind of eye-popped for me in that scenario, which I know was an extreme case with 50% of the portfolio in alts, but you raise an interesting risk profile issue because common practice with public markets is as equities start going up, you start selling them off a little bit to remain within a certain balance. But if you're in illiquid alternatives and they're rapidly appreciating, you can't do that very easily. In fact, you may have capital calls that require additional capital to go into them, and now you're overly concentrated in those alts. So I think that just adds a layer of complexity with determining how to deploy your capital efficiently and stay within those parameters. And I suppose as a layperson, I have two questions for you.
Okay.
One, and I know these are loaded questions. I'm going to ask you about the professional community and the self-directed community. If I wanted to go out and get a professional or vet a professional that I feel like is going to do a good job with alternatives, what is something as an investor that I should be looking for, or as a client of a potential advisor that I should be asking to make sure the person I'm talking to is qualified to do this kind of proper due diligence with the alternatives?
Okay, that was one question.
That was just one.
Okay, just one question. I'm just making sure I'm keeping track here.
I'll get to two in a second. That's going to be self-directed questions.
Okay, so the question on like what you should be looking for, right? So number one, and I think this is the case with any investment decision, anybody that's overseeing your finances is independence, right? Independence matters because the private markets product lineups, they tend to be higher fees. They tend to have decent marketing budgets. And you want to make sure that the individual that's making decisions on your behalf has your interests in mind. So independence is absolutely critical. You could say, well, independence is important in the public market space too, which I would agree with. But, if in the public markets you use a lot of passive, does it really make a huge difference if you're using Vanguard or iShares to get exposure to the S&P 500. Those are kind of more, I'll call them almost coin tosses. However, in the private market side of things, the span of potential outcomes is much wider. And so you really want to make sure that your professional is independent in making decisions on your behalf. And they also have to be good at what they do, right? So it's not enough just to have freedom of decision, right? The independence is a requisite, but it's not the only thing, because you can make independent decisions and not know what you're doing and get somewhere in a totally different place than you intended to be. So expertise is the other side of the coin. You need both of those to work together. Expertise means that the professionals making those decisions or the team supporting them has done it before. It's not their first rodeo if we're in Texas, right? They've got the requisite. It's not a one-person team. They've got the supporting cast that has been doing research in this space for years, hopefully decades, if possible. And they are selective in the opportunities that they bring you. They're not just bringing you the newest product all the time.
So some questions you may want to ask is, how long have you been working with private markets? What are some prior offerings that you have given to clients, and how have they performed?
Yeah,
things
track
like that.
records, good question. Yep, ask about that. Yep.
Okay.
I think also, as you're going through, if you don't get the impression that the financial professional is trying to understand where you are and where you're coming from before they give you an investment recommendation, that's a clear red flag. Because everything that your advocate should be doing for you should be aligned. Again, going back to your best interest, your financial plan, your financial objective. So if they start talking before you start talking, there's a problem, right? They don't know what you want. How can they tell you what makes sense?
Yeah. I think also technology has helped people be able to do a little bit of preliminary due diligence in a way that prior generations have not been able to. I can speak from the advisor side of the table. We are always trying to prepare ahead of a meeting to anticipate questions. One easy way to vet someone's experience with alternatives is go to any AI and just ask it, what are some key things that I'd want to ask to make sure someone is familiar or able to advise on alternatives, and bring those list of questions to the meeting and see if the advisor is prepared to answer them. And if they're prepared...
And make sure they answer them in person, right? You don't email, because then they're just going to go to the AI and ask for the answer,
that's right? So you're raising a lot of great points here, and I think this is a good way to sort of figure out who you should be working with. But let's say I am self-directed, and now my 401k offers alternatives. I got third-party institutions like fintechs and banking institutions that are pushing some alternative options, and I want to make the decision for myself, and I want to keep managing my own portfolio. What are some things that I could do to make sure I don't buy a really sketchy alternative asset? Like, should I just be reading the prospectus? Is there someone that I should go to, or are you going to sit here and say, self-direct is probably not the best idea? You should almost always be talking
I'll probably stand up and say that self-direct is not the best idea. No, I mean, even being a professional in the industry and doing this for 20 plus years, I don't operate on my own. I always plug into the smartest people that I can possibly plug into. A lot of them work here with me on a day-to-day basis, which is awesome. But being in the industry for a while, I know a lot of really smart people other places that I can plug into and get expertise where I don't have expertise. And so I would really caution anybody, even if it's a professional that's been doing it for a living, just kind of going on your own, not seeking the opinion of others. Like, to me, that's generally just not a great strategy. You're again avoiding wisdom, and so I think that's generally not something I would advise individuals to do.
Can't we just have a live podcast with you on there and people asking you questions about these?
I'm happy to do that. Yeah, let's get that set up. We'll talk to the marketing guys and compliance if we get that okayed. We actually love that. One of the things that I think is awesome about working at a small kind of family-owned, employee-owned company, and being able to meet with our clients face to face is we actually do get to have some of those discussions, and we do have some clients that are more kind of the DIY-minded individuals. And we'll get to talk about some of these private deals every now and then, and we'll help advise them on, hey, this is something that, I would ask. It's not something that we do in an official capacity, but it's just, it's one of the things that percolates up when you have a, kind of face-to-face, very candid discussion about a client's financial goals, objectives, and what's, in their mind, what's on their hearts. So I think that's, a really kind of cool thing that we get to do here at Avidian. I do want to come back to one thing that we mentioned on the private side. So we talked about risk, right?
Yes.
And I think that's really where, private markets get challenging. And number one, because the language of risk in privates versus publics is different. The language of risk in public markets is typically based on daily price observations. Okay, so there's a requisite there. You need to be able to observe daily prices, and it typically involves volatility calculated based on daily prices, or it involves tracking error, which is relative returns. How different is your portfolio going to act versus a benchmark, right? So that's the language that most investors in the public market space, and then also most clients, are going to be used to hearing. And then that language a lot of times gets translated to, conservative, moderate, aggressive, but all comes back to being able to observe daily prices. In the private market space, it's a feature, not a bug, but there are no observable daily prices in the private market world. There are services that try to fabricate observable daily prices, but there are really no, at least today, no daily transactions where money is changing hands on all private market investments. There are some, and you can say, well, we could extrapolate from those examples. But, I guess to me, the best parallel when I think about the private market risk measurement. So many of our clients are probably familiar with quantum physics and quantum mechanics.
Of course, I study it daily.
And so there's a principle in quantum mechanics called the Heisenberg principle.
Sounds uncertain.
That? Yeah, we went through that in law school, I'm sure. And so one of the things that principle states is that for a quantum particle, right, you can only know one of two things, right? You can kind of know where it is, or you can kind of know how fast it's going.
Sounds like a superposition.
Okay.
You're welcome. See, I got physics jokes ready to go.
That's a financial joke that I didn't get. Maybe it's a physics joke that I haven't heard in a while.
Yeah, it's actually the literal term when you can't determine what the spin and direction is. It's either going up or down with the spin. It's a superposition.
Yeah? Okay, awesome. Yeah. I'm thinking of superscripts. So,
nope.
So you can know one of those things but not the other, right? So you can know where the thing is, or you can know how fast it's going, but you can't know both at the same time.
Yep.
I think the same thought process applies to private markets, right? So one of the features of private markets is they don't trade every day, right? And so you can you can receive the diversifying and volatility dampening effect of private markets because they don't price every day. Or you could know the price every day, which most days is just going to be the same price as the day before or slightly up or down. If there's a significant stress event, then what you effectively capture is the fire sale price of that private asset. And most private asset investors, most private asset sponsors will not transact at a fire sale price. And so you can know that price, or you can observe that price, but there's no transactions that are going to happen.
So almost like the uncertainty of knowing exactly what it's valued every single minute of the day actually creates some stability, as opposed to a roller coaster that we see in the public markets.
Exactly. Wow. Exactly. Heisenberg would
full circle.
Would love that.
I love
taking
it.
it back.
I love it.
So last thing I wanted to touch on, which is to me the most exciting thing, is that this week, and actually today, well, today's Thursday, it's probably not going to make it out Thursday, but Thursday, September 4th, which is today, is the kickoff of the real NFL season. The Eagles are playing the Cowboys tonight. Texans are playing the Rams this weekend. Exciting stuff for me. I'm a little bit concerned. So as you guys probably know, I'm an Eagles fan. I also like the Texans. They're the home team, right? So I cheer for them as well. So I don't love having a big matchup the first week of the season. I'd much rather have a powder puff matchup where you're expected to win, and if you don't win by a lot, you still win the game, and you get to kind of learn some stuff. Having a premier matchup, your rival, the first week, always gives me a little bit of heartburn. But I'm optimistic. I think the Eagles are going to come out on top. The Rams and the Texans game is going to be an interesting one. Texans are going through some injury challenges right now. Mixon's injured. He's, one of our star players, and that's a little bit of a worry. But the reason I bring this up is CNBC's writing about the NFL today as well. They came out with I think they do this annually, valuation of NFL franchises.
Okay.
And super interesting stuff. Number one, because, you watch these teams every day. You think about, okay, who's good, who's bad? Well, the best team should probably be worth the most money. Absolutely not the case. The reason I mention that is because the Cowboys, again, are the most highly valued NFL team. I think they topped $13 billion this year, so kind of a big number. JJ is definitely raking in the cash. He's good from a financial wizardry perspective. Has that team in a number of different business ventures. But it also is always surprising because the Cowboys have had some success historically. They've struggled for a while, but the value is still there, right? And so it's very much, it just kind of reminds me that in the private world, cash flows matter, right? And it's not, especially in the sports investing world, it's not the wins and losses. It's how many eyeballs you have on the TV, how many products you're able to put in front of potential consumers, and whether those consumers are gonna transact or consume those products.
I was gonna say it's not the wins, it's the margin on the jerseys.
That's a good one, right? And it's not the name on the back of the jerseys, right? It's how many of those jerseys you can sell. So kind of interesting thing, on the investment team, and we continue to look into sports investing. It's an emerging asset class. It typically, especially with NFL teams, had not been accessible historically to wealthy individuals, even single family offices. It's becoming more accessible, and some really interesting business dynamics. Some business dynamics that seem to be fairly robust to recessions, to economic downturns. So that's always something that's positive. But so we can get excited for kind of two different reasons, right? We've got the actual stuff that we can watch on TV, but we can also get, kind of geeked out over researching a new asset class. So Robert, this has been a lot of fun. Love talking about Powerball. Best of luck to you this weekend.
Thank you.
I'm really pulling for you. I actually, you know what? I will not buy a Powerball ticket just so you can win.
I appreciate that.
All right. Y'all, it's been a fun episode of the Ask Avidian podcast. If you guys want to come check us out or learn a little bit more, just visit us at avidianwealth.com.